All right, so now the expectations are there might be a 50 basis point cut, and that's a kind of a little bit of a change in story than what we've seen here. How legit that is, as of right now, the market's taken as legitimate opportunity and possibility. We're going to take a look at how that has impacted the markets. It's really had an impact yesterday going into today. So we're going to break down the impact that it has, how it impacts our market posture, what we expect going forward if we do get that 50 basis point cut, even if it's not 2 in July, but by July and September, getting a really quick 2 cuts back to back to really jolt those inflation expectations higher, and who stands to benefit from that. And we'll look for a trade idea and with that in mind. So let's go ahead and get started. Today is Thursday, July the 18th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 on the market with the market forecast indicator, like we always do. We can see that a nice little rally at the end of the day, and we'll talk about why here later in the video. But from a market forecast perspective, the short-term sentiment bounced up, the momentum line getting out of the reversal zone. Still a strong bullish posture. So when you look at the main 3 things for the intermediate trend to persist, you have the dark green shading, which means you have a strong bullish posture. You have a rising green line, which means that we are trading above a rising 6-week moving average, and we have a rising market sentiment line. So below 80, but it's rising, and that's the key there. Being above 50 even helps. So we maintain this bullish trend that we're on right now. Of course, that's not always going to be the case. Something's going to give at some point in time. And short-term sentiment is a red flag. At least that bearish of short-term sentiment is a red flag, not to be completely ignored. But it's also not a big red flag either. It's, if you look at how far we're pulling back, we're going to get more of these extreme lows because our ranges are so small. So any day we have, remember yesterday's range was below average. As big as it was still below average. So now if we start getting above average ranges, then that's the extreme momentum line that we have to worry about. But these little dips, really haven't amounted much to anything. I think I'm going to throw this light away. It drives me crazy. But the near-term line bounced up again. It is down now. How many days? How many would this be? Let's see, this was still above 50, so 2 days now. So that's why I'm still not too concerned about this short-term pullback. Ideally, we'd like to get it back above 50, but sooner rather than later, and we'll see if that ends up happening. It took a few days over here, which is longer than normal, but you can see we still pretty much pushed up, especially I know we had a brief little dip there on the near-term line, but this really kind of looks like one big near-term rally. Brief dip, 2-day dip there that brought the near-term line below 50. But if you look at it that way, then there's the old near-term high point, and we're actually still well up above that. So that's why I'm not too concerned about how oversold this short-term sentiment is. It is a red flag, but not a big one, right? Not one to be overly concerned with. The Dow Jones Industrial Average, you can see, came off of its low point. The near-term line avoided getting down to the reversal zone on the Dow Jones. The NASDAQ Composite, its near-term line, these are other reasons why I'm not so bearish on that short-term sentiment. The near-term line here basically dipped its toe below into the lower reversal zone. And finally, the Russell 2000, same thing, as bearish, as underperformer as it's been, even showing a weak bearish posture, unlike what you see here on the others where they're strongly bullish. The Russell is trading closer towards, it's still above its rising moving average, so it's still green, and it will be green on Monday. But we have the light pink shading. Not that light pink is not the concern, it's the dark pink. That's the trend change, and we're not even to that point on the Russell 2000. So a little bit of a concern there, but again, we are a month into this bullish intermediate run right now. The expectation is it will continue. Again, 1 to 3 months is a typical time frame, so the expectation is that we'll continue here, and we'll see a short-term bounce into tomorrow and into next week. Now, when you look at a seasonality standpoint, this time of year, if you look at Oops, no, it's not what I wanted. Percentage, there we go. If we go back to like say 20 years, you can see we typically peak here at July expiration over the last 20 years, and then we just go side. We have a little bit of a decline into August expiration, but it's mostly just sideways. Not a big enough decline where we go negative, right? That occurs actually we get close to negative over here in October. So September and October tends to have the most volatility, right? We know that. But you know, August and July tend to be slow summer grinds, and we saw that last year in August and July and August. These were small ranges and small volumes, and we were grinding our way up. And you know, we've had a nice little bounce to get to this point. I don't expect us to continue this type of a trend going forward from here. I expect that we'll continue to grind slowly higher throughout July and into August. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. That will notify you when these videos are premiering, as well as when they're posted on our channel. You can mouse over our logo right here, hit that red subscribe button that pops out. There's one below the video too. That will subscribe you to our channel. Also, hit that thumbs up icon down below the video. That tells me that you want us to do the video again tomorrow. It's a quick, easy way to give us feedback. We look at that. We're very appreciative of the thumbs up we get. We notice we get a very, very high percentage of thumbs up on our videos relative to other YouTube channels. So we appreciate that. Again, that goes a long way for us in terms of your desire for us to keep doing this, as well as it tells YouTube that we have engaging content that they can share. So it works for both of us here. Join our Market Outlook email list. There's a link up there in the top right corner of your screen popping out. Click on that link to subscribe to our list. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook community that we've created on Facebook. If you're watching our video on our blog, you can also subscribe to our website at marketscholars.com. Just click this image, takes you to a form. Very easy way to do that. That will allow you to participate in our Market Outlook forums with other market scholars. Of course, our premium subscribers get access to our classes. You can see no classes the rest of this week as I'm off for the weekend now. Brandon's regular classes start back up on Monday. He taught his full week this week and is done, and he had his Q&A session went quite a few hours today. So for those of you who are our premium subscribers, make sure you're checking out his Q&A. It's always very, very valuable class that a lot of people get so much out of. This is our normal class schedule starting on Monday again. And of course, we also invite you to engage with us on social media. That, again, as always, that tells Twitter and Facebook that you want them to always push you our stuff. So the more you engage with it, the more they'll push more of it to you. The less you engage with our tweets, the more you'll just won't see. They'll just push other stuff that you're looking at into your timelines whenever you happen to be on. So that we try to make it very easy for you to engage. Just hit this heart that opens up this like button. You can click on that, and of course the Facebook, you can click on this. We got over 100 on Mondays, a little bit of a dip on Wednesday here, so let's see if we can't get that number up above 100 as well. Of course, you can do that again right now while you're watching. Alright, back to the charts, and you see how even with the pullback today, remember the open of this week's Hakinyashi down to 29.69. We're at 29.95 with the rally today. So we're still pretty bullish. Now, granted, the next week's candle is going to open up here between halfway between the open and the close. So we're looking at 3,095. Where's my calculator? Here it is. So we're looking at 3,095 plus the 29.69, 28. That's going to put next week's open at 29.85. So next week, and depending upon how we close tomorrow, next week is going to be more of a possibility that it could turn into a transition candle. So that's definitely something to keep an eye on, how we close and where we close. If we close closer towards this 29.85 level with a down week, then like I said, start looking for potential transitions where we have a small body with an upper and a lower shadow, similar to this one right here. We're obviously not there yet. You can see, we're still above the 50 and 200-day moving averages. The 50 and 200-day moving averages are rising as well. Here, a very strong candle on the NASDAQ composite and very strong candle. So, it's kind of hard to be too concerned when the trend remains, so strong on all of these major indexes, aside from the Russell 2000. From a 3 green arrow standpoint, of course, you got the 1 red arrow, and that's why everybody is so concerned, right? It's like, oh no, we actually have a pullback, heaven forbid. You can see it's not like we're extremely overbought. We weren't even really extremely overbought on these short-term levels. Like there's the 6 month, the 3 month. We never really even got outside the first standard deviation. So we're just grinding. When we're inside the first standard deviation channel above the linear regression line, we're just grinding higher, whether it's 3 months, whether it's 6 months, whether it's the full year. We've pulled back to linear regression, but we're still in the upper half of the range. We're still bullish, right? And there's your 1 year, still in the upper half. We pull back a little bit below here. When we were on 6.319, you can see what it looked like then. 6.319, we'll go over to 6.4 of 18. So we had pulled back just a dip below the midpoint of the chart after having gotten into the upper half. And of course, as we know, since then, it was a rally back, right? Rally back into. Now you see the linear regression since has moved up because we've had more trading up here. So, but this, back then it was just sitting right about at my level. And 1 day later, we were right back above linear regression. So, it puts these pullbacks in context, and not very much of one. And then, like I said, even on the 3 month basis, and of course, even on the 4 week basis, we're still easily in the upper half of this trend line, with this best fit trend line channel. And of course, when you look at the Bollinger Bands here, we're still above the value area. So, once you break below that value area, now we're concerned. And even then, you still got a strong support level. You got multiple layers of strong support. So, we pull back. We're not going to fall off a cliff at the very least. In fact, we're going to pull back to areas that will be very good opportunities for buying, to be able to be a little bit more directional and speculative. Whereas right now, while we can be a little bit more directional, we might not be too speculative, because it's kind of hard to make wildly speculative directional trades when the market just grinds and it doesn't move very much, especially in the upward direction. Here's a 2-line version of the S&P, and basically we opened up on the 17-day moving average, held it, and have bounced back up. In fact, we have bounced back up above the 8-day moving average, just barely, but we got right back above the 8-day, with buyers still in control, below the moving average, but buyers still in control, being in the upper reversal zone. And you still have strong, we're losing some momentum, but it's still strong positive momentum in terms of its position of where it's at. All right, if we look at the volume, the 4-week range here, you see we pulled down. We had broke below this volume node at the very close of the day yesterday, but still traded in this range. The volume node being at the old near-term high point in the market forecast. There's a near-term low point where the point of control is, and that's what we hit today. So we hit that for support. We actually did that while we were in class. Actually earlier in the morning, we bounced off of that. My class started about right here, and at that point we were already into this channel. We talked about, as we rallied, we'll probably move up into this area and then hold for resistance there, and that's ultimately what we did. In fact, it kind of occurred while we were in class. That breakout occurred. So and that's where we held, and again, lower highs and lower lows, but the fact that we closed at the high of the day, the fact that we closed above the previous day's low point, pretty much in the middle of yesterday's range, means that while it's not a bullish candle, it's obviously not a very bearish candle either. And then you look at the trading range, and the trading range and volumes, a little bit above average on the trading range, a little bit above average on the volumes. When you put those into context of 52 million and 2.5 point range, the 2.5 point range is like right here. So still very low. It's the 4 and 5 point ranges that we concern ourselves with, right? We just don't have that right now. Even here, this range was a 3 point range on that day, and that was just a little bit above the ATR. Right here, 3 point range was just a little bit above the ATR at that point, right? So, Again, it's when you're in the kind of upper in the middle. We don't want to be too extreme to the upside because then that's just a super buy the dip. But if it's like 4 and 5 points, 4.5 points, those are the big ranges that turn into more bearish runs, kind of like we saw eventually over here. That led to more of an extended downward move and not just a buy the dip. Over here, the range was 9 points. That was obviously well outside, but it really kind of broke us out of a range. And then broke us out of a really slow, extended period of time that we're pretty much heading into right now with the ATR to price ratio below 1% and sticking there. That's when you know you're entrenched in this bullish trend. And the other way you know that you're entrenched in a bullish trend is volatility is in this half of the chart. It's well below 90%, and that 90% is acting as resistance, which is what we got to at the open today, and then we fell gradually throughout the day. With volatility dropping. So still easily inside the nice, the bullish zone and closer to the bullish sweet spot than even getting into the neutral zone, which is when you're concerned now, not necessarily that we're bearish, but that the bullish trend is done, right? When you start breaking more into that neutral zone. All right, so before we look at some other charts, let's take a pause just to summarize here really quick our posture. So our posture remains bullish. We've had a near-term pullback. It, had some inklings of being a, pretty bearish short-term sentiment, but all in all, still not bearish enough to be worrying about an imminent trend change. At worst, a weak bearish posture, but not a trend-changing bearish posture. More of just an extended pullback, and it doesn't even look like we're going to get that. So depending upon, of course, how we close the week and going into next week, it looks more and more like we are still firmly established in this bullish posture and this bullish trend. We had some short-term weakness, maybe a little quicker than expected this week, but now we're looking like we are hitting a low point and starting to work our way back up to the upside. Now, as we bounce up to the upside, that doesn't necessarily mean that we're going to bounce up like a rocket, right? Volatility is already very low. We are in that time of year where it's hard to go up as it is from a seasonality perspective. So any bullish trends that we may continue from here based on the posture would just be slow and boring and grinding, which is not necessarily good for those of you who speculate on really directional trades, especially to the upside. But it is good for those of you who just sell premium like we do in a few of our options classes that we have here during the week. This is the time of year where we can just grind our way and hedge that grind with the time decay that we make money on in those types of trades. For an example, in our with IWM, I showed this in our inventory trading class that we did this week. IWM has been our best performer all year long in our total active trading portfolio, and the reason why is, in fact, it's actually done better with the losses in our portfolio management class that we've had because it's been an underperformer in that class. The gains that we have this year alone, as it's been sideways as can be in the inventory trading, has more than offset the underperformance from the portfolio management class. So, which is the point. That's the benefit. That's the benefit of that style of trading. And as you can see, again, when things grind, that doesn't mean that you just can't make money anymore. So what do you think about that posture? Do you agree or disagree with it? There's a link popping out right there. Click that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on what you're seeing that either tells you we are probably headed towards more of a bearish run, or look out above, right? We're about to rocket up Apollo 11 style to the moon. All right, if you take a look now at what's driving the price action, again, you can see, looking at, let's look at the last couple of days here. So we'll go to July, the 17th through the 18th, because we saw this yesterday as well, and it's been a continuation, right? We had the big move in gold. That was a big move yesterday, and then the bearish move was in crude oil. Well, look at this. Another big move in gold, another bearish move in crude oil. You can see that we have weakness in the dollar, which is helping propel gold up. It's also helping propel emerging markets and developed market stocks to outperform their U.S. counterparts. U.S. and small and large caps kind of working at the same point there. You can also see long-term bonds are doing really well, so bond yields are pushing down. If I take a look at the bond yield pullback that we've had, you can see the pullback. Now, keep in mind, if I go back to that linear regression channel here on yields, there's not, like, from a depth standpoint, you know, when we were here at on, what was that be, 7.319, so let's come back over here to 7.3 of 19, and we'll go to 7.4 of last year. It's obviously a holiday. You can see how close we were outside the first standard deviation, close to the second standard deviation. That's a pretty extended move to the downside for the 10-year bond. And you can see how high the ATR has moved up. So it's gotten really volatile. Bond yields has gotten really volatile. If you look at TLT in the same mode, there again on 7.3, well outside the first standard deviation, not as volatile over here, but you can see even up pretty much up to the second standard deviation channel there. So now let's go back to this year, or this move, and you can see we are bouncing up, but probably not going to. When you get that surge outside of the channel, you typically don't follow that up with another surge, and I expect that we'll still continue to kind of top out here and work our way back down on bonds and up on yields as the market moves towards this end of the FOMC meeting. You can see that here. Let me update these with the odds that we currently have. You can see that the odds of a 50 basis point cut have moved up. Look at that, to 69%. So in other words, what the Fed may be, at least what the futures market is suggesting, is that the Fed may be doing one kind of a shock and awe move to get inflation expectations jumping, which would get the yields jumping as well as commodity prices jumping too. And of course, that's bearish for the dollar when we are easing as much as we are, especially changing so dramatically like that. That's a pretty dramatic shift. That, I mean, just yesterday we were at 34%. A month ago, or even a week ago, we were about half of that, and now we're all the way up to 70%. Now that's not baked in the cake, so the market's not. It's a high probability of 50 basis points, but it's not set, right? That's usually when you get above the 80% mark, and we're not there. But dang, that's pretty close. Of course, now we're at a 97% chance that we will get a second cut by the end of the year. So that's really moved from where it was about 85% a month ago. And then by April, looking for the third cut, you've got about an 88% chance of getting a third cut by April. So whenever that would be, right? If we get 2 in July, you've got 1, 2, 3, 4, 5, 6 meetings to get one more. And now when you're looking for a fourth, then you're looking at what, 36 plus another 2%, so about 38% of getting a fourth. So you're about 62% odds. So high probability of getting a fourth by April, but not set in stone, right? The third one pretty much is, but it could be that if we get 50 in July, it could be 1, 2, 3, 4, 5, 6 meetings to try to get that next one, and of course that's having an impact. So again, if inflation expectations take off again, then this little pullback on yields may ultimately be an inverse head and shoulders pattern. It'll be very temporary. And the move that we had on the dollar, we'll look for more of a decline as it continued down by the end of the day. You look for more of a decline to the downside. You look at the 5-year chart and look how tight we've been falling around this best fit trend line. Now that's a really, really tight range. The Bollinger Bands on the long-term charts for this has been, let's go back to DXY, has really, really moved down. Look how low the bandwidth is for dollar movement. So it's tightening up for a breakout. If and when it occurs, right? This is a weekly chart, so every period on here is a week. So if it takes a few periods, it's going to take a few weeks. So it might take a while, but still, that is a very, very low volatility for the dollar. And like I said, setting up for a a breakout in some direction. And you can see with resistance holding and the expectation of an easing Fed, if you had to guess on a direction, you'd most likely guess to the downside. And that has its implications on stocks, which is bullish for stocks, especially international stocks, and would also have its implications on crude oil, which would make this little dip that we've had also temporary and a buyable opportunity, considering here's the pullback down to the lower band. You know, the moving average and the lower band can act as a support in a bullish trend. So you look for, you know, a bounce off of this and move up higher again. Again, all of that would be bullish for equities too. Maybe more bullish for, as you see over the last 2 days, and I showed you with emerging markets and U.S. stocks. Here, if I just look at today and yesterday, you know, these 2 days that we were that the dollar is down, you can see emerging and developed stocks outperforming to a small extent, and the more we go down the dollar, the bigger the discrepancy will be. I showed this chart today in class, in our portfolio management class, and you can see this on a weekly chart that the tide of the dollar is shifting. So all of these currencies are against the dollar. So as they go up and over here to the right, that is weakness in the dollar. And this is long term, right? This isn't a short term move. These are more longer term moves. And you can see it's not the hugest move. So we're not like going crazy here. But the tide is shifting for the dollar towards underperformance. And that's not a bad thing for risk appetite. From a sector standpoint, again, you can see that this is the 2 days that the dollar's been weak. Now, granted, we are in heavy mode for earnings announcements, right? So industrials were the big downer yesterday. Well, you can see with CSX, right? Today, Netflix really pushing communication services down. So keep that in mind about these two. And of course, the weakness in crude oil, which, like we just mentioned, we expect to be temporary, is pressured energy stocks, which have been really underperforming even with the rally that we've had in crude oil. And there's your discretionary stocks too. People kind of, again, all earnings related. To the upside, look at what's been winning. You have healthcare, you have staples, you have utilities, real estate lacking behind, but you have some really good opportunities in these kind of safe havens. They have been winning. They have been outperforming over the long term, which is actually a bullish sign going forward, as I've said before countless times. And you can see technology, financials outperforming, which is a good sign for them. You would expect financials to continue to outperform if yields do start to rally up with higher inflation expectations. Again, there'll be a knee-jerk reaction on the rate cut, especially if we did get 50 basis points. If for somehow we did get 50 basis points, yields will fall dramatically, pretty sharply, but there will most likely be a knee-jerk reaction where, again, that will lift up inflation expectations, which always precedes actual inflation levels, and then you'll start to see yields rally in addition to that, and along with those commodity prices and continued weakness in the dollar, because that's what inflation expectations, you know, that's the reaction to rising or falling inflation expectations, is strength in yields, strength or weakness in the dollar, in the currency, strength in commodity prices, and to a lesser extent strength in equities as well, especially international equities. And from a sector rotation standpoint, strength in energy stocks, strength in material stocks, and strength in industrial stocks, which are showing some weakness here because of their own kind of temporary issues, which might ultimately be buying opportunities for us. All right, now with the idea that rates would rise and that would be beneficial to financial stocks, we see a stock that actually came out with earnings this week, and that's Bank of New York Mellon. You can see following through into yesterday's upper end of the range with the close above that high point. Now, we're not out of the zone. We're not totally breaking out here. We don't have a lot of volume, and market sentiment's extremely low, but you can see that, you know, we are getting the signs of some positive developments. You have a dark green shading, rising green line developing here. You can see from a 3 green arrow standpoint, you have 3 green arrows coming out of this earnings. Again, would have the rising green line as well. From a long-term standpoint, there is still that 50-day moving average that we're trading up against here at 45 We need to get through. You can see the transition candle on the Hakenyashi that you would expect to continue to push through that and then fill in the gap between the 50 and 200-day moving averages, as we've seen before. Some other factors to keep in mind from an Ichimoku standpoint. You can see the nice little breakout finally to get up into this area. Again, there's some resistance here in the cloud. You get through the cloud, you start looking for a move up through it to the top of it, similar to that 50 to 200-day moving average element. If I were to take a look at the Bollinger Bands, you can see that we've been more positive than we've been in a while on this. So a very strong move, stronger move to the upside than what we saw over here coming out of that earnings. And you can see the bandwidth starting to rise up. You can see the zone of volume that we have below us and the lack of volume that we have up above us. So again, another reason, at $48 here, where let's see, go back to here. $48, right where that 200-day moving average right now is. So you can see how you can move up through there and then find some resistance at that 200-day moving average. And then finally, you look at like the DMI, which has also been very depressed from a positive DMI standpoint. You're finally getting the positive to almost break up above 25, but at its highest level than it's been for a while here. And then you can see the orange line dipping below 20 for the first time. So we're getting inklings of some positive elements in this financial sector that we're looking for some positive news, positive trends to come out of because of this potential rate environment and rising inflation expectations environment that we expect this to do well in. We can sell. Right now we have the opportunity. I've got a couple of trades queued up in here, but I think you have the opportunity to sell. What do we have here? The 44 put, 38 delta, and then again this is a weekly, so this would be almost 45 days out, but you can sell that 38 by the 42, and you can see you're getting enough credit here to justify that risk. You need to get at least 47 cents. I would say because we're at that resistance level, I'm not too concerned with a big drop to the downside. But if we do kind of grind our way higher, then we probably want a position size smaller than normal. I don't think you have to like cut it in half because we're through earnings. There isn't any big risk events coming up aside from the FOMC meeting. But like I said, if a double cut, watch for the knee-jerk reaction, but a double cut eventually leads to a ramp up in inflation expectations. Yields will follow suit, and financials have shown they would like that, right? They've really struggled in this falling inflation expectations environment, and they would benefit from things reversing back to the upside. All right, well, that does it for today, and you've heard from me. Now I want to hear from you. Let's use that link right there to go to our Market Outlook forums. Let's keep the conversation going. Any questions, comments, anything you want my take on or others take on, make sure you open up a new thread there. You can also reply to other people's threads as well. Remember, you have to subscribe to our site to do that, but it's free to participate in the Market Outlook forums. You can do that for free, of course. Our classes are a different story and some of the other benefits we have, but you can participate in the forums for free in that particular forum. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content in between the videos. Remember to join our website and our community at marketscholars.com, as well as the community we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.